All right, welcome to this week's episode of DoubleLine Minutes. I'm Jeff Mayberry with Ryan Kimmel.
Yo, yo.
It's 10 a.m. Pacific time here, July 25th. As you can tell, I'm fighting a little bit of a cold here, and we'll let Ryan do all the heavy lifting. But it seems like it was a pretty quiet week, so maybe this will be a pretty short one. Let's get into the returns here, and for the week, S&P 500 all-time highs was an all-time high every single day this week. Even though one day was a whopping 6 basis points. Oh, and Thursday was a 7 basis point move. But still higher every day. Up is up, as we like to say around here. All sectors positive on the week. Your big winner was healthcare, up 3%, though healthcare is the only sector that is negative on a year-to-date basis, down about 30 basis points year-to-date. Second best one was real estate, up 2%. And industrials up also 2%. So pretty good breadth in terms of your sector performance. Staples was the laggard, up 50 basis points, and tech, the number 10th ranked sector, up only 60 basis points on the week. If you're looking at a month to date, comm services, the only negative sector, down 80 basis points or so month to date. Everything else positive, and looks like industrials the big winner there, up 4.7%. Given that breadth, not surprising to see, S&P was up 1.5, S&P equal weight up 1.6. Given that breadth there, Nasdaq up 1.2, growth and value kind of in line there, 1.4 for growth and 1.3 for value. So, a pretty quiet way to keep getting all-time highs there. But as Kimball likes to say, it's you got to have all-time highs before you get all-time highs.
Yeah, you got to say, like, this melt up in equities has been pretty impressive, just inflicting like the utmost pain on the bears out there. You're seeing the VIX, drop to lowest levels since February, getting near kind of year-to-date lows. And it does seem like, the market's been finding some comfort and support with the solid earnings season we've seen so far for Q2. I think we're just over like 25% of the companies have reported so far. And of those, 83% of the companies have been coming in better than expectations on their profit announcements, which is kind of the highest beat rate we've seen since 2021. So kind of, fundamentally looks pretty good. But it does seem like, there's some bit of froth in the market. We got the return of the meme stock mania. It reminded me a bit of 2021 when we just saw those, meme stocks just, up like multiples in in a matter of days. And Goldman Sachs had a pretty interesting note overnight, just highlighting how, speculative trading is at the highest level seen since 2021, which interestingly doesn't necessarily mean, stocks underperform in the near term. It actually is a signal, like if you look at just historical data, stocks actually outperform in the near term when you have this elevated speculative trading levels. So it's just markets can stay frothier longer than you expect.
It does seem though like it's not an extended period of time for these meme stocks. It's not like up 100% or 200% every single day. It seems like it's like a one day move or a couple day move, and then they kind of come back down, not down to earth, but come back down, to low Earth orbit. They're not just kind of going sky high every single day.
Yeah, it's definitely not as crazy as 2021.
Yeah, I guess maybe it's just people don't have the stimmy checks in their
Yeah,
pockets.
exactly. Exactly. Less firepower.
Yeah. All right, let's shift gears to bonds here for a second. And bond market 10-year was down 4 basis points on the week. 2-year up 4 basis points, so a little bit of a flattening there for the bond market. It made that 10-year 4 basis point move made the ag up 36 basis points on the week. Looks like investment grade corporates, your best performer, up 66 basis points. And of your traditional sectors, part of that's probably on the back of Ryan, what you said, kind of strong earnings. I guess that means your default risk not that your default risk in investment grade is high. But you're really not worried about that, and get a little bit of spread tightening there on investment grade corporates. Agency mortgages up a quarter point, and government's up 35 basis points or so. If you go to your riskier sectors, high yield up half a percent, EM up 90 basis points. So your big winner there on the week is EM, and bank loans flat on the week. Kind of year to date, everything up. Ag up 3.6%. Looks like your big winner, high yield, at 5.2 and EM 6.5. So pretty much a across the board sweep there. Positive news from the bond market, or positive performance from the bond market, on a little bit of a flattening there.
It's pretty wild. Like the 10-year yield at 440 is just like right smack dab in the middle of its year-to-date range. Like 480 the high, 400 is the low on the year. It's just that 10-year part of the curve has just been so directionless and range bound over the past 7 months. And it seems like there's just a lack of catalyst for it to really break out in either direction.
Yeah, it's interesting. I've been doing a lot of quarterly calls, and when you look at the shape of the curve for the second quarter, like the 10-year was, a 2 basis point move, but you really had that steepening, the 2-year down, the long bond up, kind of pivoting around that 10-year. So you're right, like the 10-year has just been almost solid as a rock around here. But speaking of not solid as a rock, let's talk about commodities. Bloomberg Commodity Index down 1.5%. The big loser was energy, down 4.5%. And then you kind of look and you go, oh well, what oil do? And oil is down only 1%. And so that means, what's the big loser? That has to be natural gas, and natural gas is down only 11.5% on the week. So that's on a total return basis too. So not great there for natural gas, but it is something that it is volatile. We'll probably see it up 12% or something next week, and then see what happens there. But industrial metals up 1.5%. Precious metals down 65 basis points, with copper leading the way for industrials, up 3%, and gold at 33.29. Spot gold, that's down about 75 basis points on the week. And then if we want to kind of look at, Bitcoin actually is off on the week, down to 116,000. So give a little bit of that all-time high back there from Bitcoin. And that kind of wraps up the market. Pretty quiet week there, Ryan. You want to speaking of quiet weeks, get into the macro side of things, and kind of talk about how things are trending.
Yeah, sure. Yeah, as you mentioned, pretty quiet week on the macro front. The data that came out this week was, I'd classify it as like tier 2, tier 3 economic data. We started the week off on Monday with the Conference Board leading economic indicator, which I don't really put too much credence into this indicator lately. It's been pretty wrong over the last few years, but for what it's worth, it declined 30 basis points month over month in June, in line with consensus. That did bring the 6-month annualized growth rate lower into further negative territory. It was down 5.4% on an annualized basis. So it continues to be a negative signal for the economic front. If you just look under the hood at what was driving those negative dynamics, it was consumer expectations, ISM new orders, and jobless claims, while your more financial market indicators, stock prices, and credit, those were the contributors. And on Wednesday, we had some housing data. We had existing home sales. It came in weaker than expected. It declined 2.7% on the month for June. On a seasonally adjusted annualized run rate, that was going at 3.93 million, which was a 9-month low. It was really driven by a decline in single family sales. We did see inventories rise, to 4.7 months supply, which was the highest level going back to 2016. Then on a similar theme, on Thursday, we had new home sales, which rose less than expected for June. It was up 60 basis points on the month. Market was expecting a rise of 4.3%. Median home prices declined 2.9% year over year to just over 400K. And you're seeing this a rise in inventories, where inventories and new homes are the highest levels going back to 2007. So it just seemed like home builders are offering a lot of price incentives to try and offload some of this inventory, maybe putting some downward pricing on new home sales. I guess on a positive note, that should help the shelter inflation numbers in the future. So looking at it at a glass half full lens. And on Thursday, we also had initial jobless claims. This came out, I'd say this was a positive read. The initial jobless claims declined 4,000 to 217K. The 4-week moving average decreased to 224.5, which was a 3-month low. So that's moving in the right direction. You did see continuing claims kind of gravitate a little bit higher to 1.955 million, which is pretty close to the highest, the cycle highest level we've seen since November 2021. But we've seen a bit of a stability in the last month or so. So not really a big warning sign. It's just maybe some signals that people that are being laid off, it's just taking them longer to find jobs. Also on Thursday, we had the July preliminary PMI release from the S&P Global number. It was a mixed bag. You saw the manufacturing component that dipped back into contractionary territory at 49.5, but services that came in stronger than expected, moved up to 55.2, well above 50, which is a signal that you're in expansion territory. And this is a theme that we've been seeing over the past couple of years, where services remain strong, manufacturing is weak. But being that services represents 80% of employment, it kind of keeps it supports the labor market. You look at the underlying components of this PMI report, in the manufacturing, the employment and new orders component was kind of weak. But both on the services and the manufacturing side, the participants signaling that, there are some upward price pressures, which, tariff related, and, we could see that filter through into the official CPI data and PCE data in the coming months. Then finally, this morning, we had headline durable goods orders that declined, basically in line with expectations. It was down 9.3% month over month. That was driven by a 52% decline in aircraft orders. So if you strip out that volatile transportation segment, saw new orders rise by 20 bips. I like to look at capital goods orders, non-defense, and excluding aircraft. That was up 70 basis points. Or sorry, that was down 70 basis points, while shipments rose 40 basis points. And generally, when you see orders dip below shipments, that can be a negative signal for investment growth. So something to watch going forward. But it has been pretty volatile over the past couple months. And that wraps it up on the economic front.
Yeah, so nothing really sticks out there, as you said, kind of a quiet week. I guess the jobless claims really, because of their trend is looking pretty good, and not really anything that the Fed needs to worry about, that we're getting into a more of a recessionary environment. And you can kind of see that in the Fed market pricing. We have a 3% chance of a cut next week on Wednesday. It's only 66%, kind of surprisingly, in September. And then the market's really only pricing in 1.75 cuts here this year, with 1.13%, or chance of 113% chance of a cut in October. So it'll be interesting to see kind of what Jay Powell talks about next week on Wednesday. It was a blackout week this week, and so there's no Fed speak out there. We did get to see Jay in a hard hat yesterday, which was pretty amusing. It seemed like it was more performative, given that some people were not wearing hard hats. But it was interesting to see at least Jay out there, looking at the new Fed, or the renovated Fed building there. But that was about all we got from the Fed speaker. So all eyes on Wednesday here. But with that, Ryan, it is a busy week next week for a macro front. It is Pizza Friday on August 1st. And so we want to cover things to keep an eye on for next week.
Yeah, I mean, first and foremost, as you mentioned, FOMC meeting on Wednesday will be kind of the center of attention. Market's not expecting any moves, but it'll be interesting to see if there are any dissents. It does seem like Waller is calling for a 25 basis point cut next week. So I think that'll be interesting. And then anything we can glean from the press conference after the announcement. But we do get a
Well, I was going to say that I think the dissents are going to be more performative because they know it's not going to be like, I think what is it, 11 votes or nine? There's nine, right?
yeah.
And so it's not going to be like 5-4 one way or the other. So if you have two people dissenting, it's not like they're like it's more like, oh, we're dissenting because we think we should cut rates, even though they know that rates are not going to be cut,
Yeah,
right? So it's not like a very close call here. So it could just be posturing for the next Fed chair position.
a bit of an audition. Yeah, and
Yep.
as you said, I think the market's like Waller's kind of telegraphed his position pretty well, so I don't think the market will be surprised to see him
Yep.
descend.
I agree.
But on the eco front, we get a nice update on the labor market. So on Tuesday, we get the JOLTS job openings data, give us a gauge on labor demand for the month of June. Then we get the advanced release of the GDP, where the economists are expecting a bit of a rebound on the quarterly data. Then we have PCE inflation on Thursday, where economists are expecting a bit of an acceleration in inflation. The core PCE month over month, they're expecting a 30 basis point increase, which would be a bit of a rise from the previous month. Then on Friday, we get the payrolls report. Be pretty interesting to see how this plays out. Market's expecting 110,000 job additions for the month, a bit lower than the previous month. They're also expecting the unemployment rate to rise 0.1% to 4.2%. That'll be interesting to see as well. See how the participation rate feeds into that. And yeah, that really wraps it up. I think another important part of that employment component too would be like the private payrolls. Last month that was weak at 74,000, I believe. So see if there's any rebound in those private payroll numbers for the month of July.
And it was this point last year, right, when we got kind of the weak payroll numbers and people were starting to freak out that we're going into like a recession, and the Fed didn't cut rates, but they cut rates here in September last year, and so it'd be interesting to see whether we get that kind of same trend because obviously we're looking at seasonally adjusted numbers, and if the seasonal adjustments kind of skew things, they skewed things, maybe last year, whether that happens again this year or not, and whether people kind of look through it or, freak out again. So that's always a fun thing to kind of keep in mind.
Yep.
But with that, I think that wraps it up for this week.
Yes, thank you to our listeners out there today on DL Minutes. Hit us up on X at DLine Minutes or send us an email at minutes@doubleline.com with any questions, comments, or suggestions.
Don't forget our YouTube channel is at youtube.com/doubleline capital. We have Jeff Sherman's webcast up from last week up there. And always good time to catch up on all that content that we do have on our YouTube channel there. So I'd like to thank everyone for tuning in and hope everyone has a great weekend.
Thanks, everyone. Take care.
This presentation was recorded on the date indicated. Views and opinions expressed herein are those of the individual and do not necessarily reflect the views of DoubleLine Capital LP, its affiliates, or employees.